in 1998 to nearly $600 billion in the U.S. alone by 2007, and then more than doubled from 2008 to 2013 to $1.4 trillion. What fueled this phenomenal growth? ETFs offer most of the advantages of a low-cost index fund, plus a few tidbits that mutual funds can't match. Let's go down the list. First, ETFs let a small investor buy a highly diversified asset that pretty much guarantees him the market return while offering extremely low expense fees. Some ETFs track a broad market index. Some target much more narrow industries, trading diversification for the chance to take greater risks if an investor wants to bet on a specific niche. Of course, just like a mutual fund that focuses on a narrow market sector, an ETF designed to move with a narrow sector exposes you to more risk. When the financial sector crashed in 2008, the most popular ETF for financial stocks, the Financial Select Sector SPDR, lost about 3/4 of its value. The broader market took major losses too, but not to the tune of 75%. If you decide that you want to roll the dice, then you can even buy a leveraged ETF. The ETF's management borrows money and buys more stocks. It's like buying on margin, except that it happens within the fund instead of you doing it yourself. Some ETFs are designed to move twice as much as their index, or even more. That means that a 1% increase in the S&P 500 will result in a 2 or 3% increase in your ETF. If you think that's too good to be true, then you're right. There's a downside to leverage. A loss gets multiplied too. A market loss of 1% will mean a 2% loss for you. That doesn't sound like nearly as much fun, does it? Levered ETFs aren't necessarily bad, mind you, but you need to know what you're getting. ETFs can outperform an index fund as often as not because they have reduced levels of what the street calls cost of flow. Cost of flow is the expense of providing shareholder liquidity by moving mutual fund shareholders into and out of the fund. Academic research shows that cost of flow can hurt a mutual fund's performance by as much as 0.5 percentage point or more annually. ETFs don't incur the costs of fund redemptions. Investors just buy or sell their shares on the open market. Because ETFs trade like equities, investors can use some of the special types of trading tools we discussed in Lecture 9, such as stop loss and limit orders, short sales, and margin purchases. You can't do that with a mutual fund. Some ETFs even offer options trading. If you decide to buy or sell at, say, noon, and you think the prices will move against you during the rest of the day, you can make your trade immediately with an ETF because they trade throughout the day. With a mutual fund, you have to wait for the end of the day so that the fund can compute net asset value. ETFs might have a lower tax bite too. Investors in both ETFs and mutual funds incur taxes in two ways. First, they pay taxes on any gains in the investment at the time of the sale. And second, they pay taxes on any capital gain that the fund distributes to you. The second point is how an ETF and a mutual fund may differ. Compared to an actively managed index fund, ETFs usually distribute capital gains less often than mutual funds. It's worth mentioning that all stock mutual fund distributions are taxable, even if reinvested in the fund. I don't buy a fund of any sort just before its distribution date, usually near the end of the year or quarter. The fund will take your money, turn around and give you some of it back almost immediately, and then you get a tax bill. Bad idea. ETFs aren't perfect. They do have their drawbacks. Buying or selling ETFs will cost you more than getting into and out of a mutual fund because you'll usually pay a brokerage commission or a bid-ask spread. Some ETFs don't trade much, relatively speaking, so the commission or bid-ask spread might be bigger than you'd like. If you think you'll be trading your ETFs more than a couple times a year, then a mutual fund will probably be a better choice. We've only scratched the surface of the huge world of mutual funds and investment companies. If you'd like to learn more, you'll find tons of information. Your biggest task won't be finding it. It'll be sifting through it and making sense out of it. The web is a great resource. A good place to start is Morningstar. Morningstar is known for its fund ratings and also offers investment management services. It had almost $160 billion in assets under advisement or management in March 2013, with a footprint in 27 countries. You can learn a lot from the Investment Company Institute, and Yahoo Finance is a great place to visit too. You can find all of them on the web. If you're interested in a specific fund, get yourself a copy of the fund prospectus and a cup of strong coffee. Reading a prospectus isn't for the faint of heart. Don't tell anyone, but I've never read one cover to cover. Instead, I use a prospectus like a dictionary. When I want to know something about a fund, then I go to the prospectus, preferably an electronic copy so I can search it. You can search for keywords like fees or investment objective. In our next lesson, we'll learn two of the best and easiest ways to improve your investment returns: minimizing taxes and transactions costs.